Charlie Munger once said, the big money is not in buying and selling, but in the waiting. And what a market yesterday or the last 2 days were. I think if each one of you who have been tracking the market very closely would know that on 31st May we closed the Nifty, and today the Nifty close is still above. But the last 3 days has really given us a lot of jitter. And what has happened, definitely a very big event which has passed by yesterday. And to discuss this and beyond this, we have Mr. Navneet Munot. So before I hand over and the discussion to Mr. Navneet, I'll give a quick introduction of Sir. Mr. Navneet Munot is MD and CEO of HDFC Asset Management Company. He has joined the firm in Feb 2021. As we all know, HDFC AMC is one of the largest AMC, managing more than 5 lakh crores of assets and over 75 lakh investors across the country. Mr. Navneet is also the chairman of AMFI, a veteran in the financial market, and prior to this role, he was executive director and CIO with SBI Asset Management Company, and he was overseeing the Indian and the AUM over $150 billion. Okay, and good evening, everyone, and thanks for joining. This is Abhishek Mehrotra, Head of Investment Products with HDFC Securities, and we have Mr. Navneet Munot. Sir, what a day yesterday was, and probably the last 2 days has been really very exciting for everyone. I still remember up to our HNIs and even to my, building guard who was watching the election results. What a surprise it was. Now, since the event is behind us, how do you see this event happening, and what are your views about the macros, about the economy, and how things will move forward from now, from the market perspective and from the overall perspective of the market?
So, thanks, Abhishek, and good that you started with that famous quote of Charlie Munger that it's not the buying and selling, but in the long run, money is made through the waiting. As you also puts it, like, investing is like seeing the grass grow or seeing the paint dry. And if you want excitement in life, then go to Las Vegas. I think in last 3 days, we have seen maybe the people who want that excitement, I think they had a lot of excitement. I think on a more serious note, you rightly mentioned, I think the event is behind us. From here on, we'll be back to the regular news flow in terms of what's happening on the macro, what's happening on corporate profits, the liquidity flow, so on and so forth. Over the next few days, the government gets formed, and then of course the eyes will be on budget. But all of this is like a regular news flow. Something or other will always be there. Over the last 2 years, we have seen significant global developments, be it the geopolitics, be it the significant changes in the interest rate environment globally, the rise of inflation, so on and so forth. But what's more important is that for investors in India, we are in an economy which, from a macro perspective, I think whether it's the macroeconomic stability, the financial stability, the corporate balance sheet, and the financial sector balance sheet, they have been in like best ever shape. The external sector, whether you look at current account, whether you look at balance of payment, whether you look at the size of foreign exchange reserves, best ever shape. Thanks to 3Ds, like in the budget I talk about, the digitization has led to record high. I mean, digitization has done a lot of good to the country, but talking about the macro environment, has done a lot of good to the higher tax revenues. I mean, we saw the record GST revenues. Digitization has helped in like bringing down the revenue expenditure on through the DBT, and the dividend from RBI and other PSUs has kept the fiscal house in order. From a monetary policy perspective, India is relatively better placed. We have like high growth at 8%, while inflation is well contained. So when we compare India with most of the other parts of the world, it really looks an oasis of hope. And still, I mean, starting from a low base, we have a long way to go. But as you rightly mentioned, over the last few days, I think politics overweighed everything. People weren't discussing much about this overall macro outlook about India, but were focusing on the number of seats that or in what form the parliament, I think the new Lok Sabha will look like. That's behind us. It's been digested, and I hope that over the next several months and several quarters, we will continue to see. I mean, we will see the continuity of the reforms that we have seen, and we will see the rising interest in Indian markets.
So even with yesterday's level, if I see, we are still 21 times forward earning, P levels, and which is just second to the most expensive market, which is Japan. So what do you feel, is it justified, and how an investor should approach this valuations? And because valuation is something which we always talk about, and a lot of clients do worry about the valuation in which we are trading.
So whenever anybody asks me about like bazaar kya lagta hai, what do you think of the market? So the framework is like this. We look at four things. We look at macro, we look at corporate profit trajectory, third we look at liquidity or sentiments, and fourth is the valuation. Not in any particular order. From macro, I've already talked about whether we look at the balance sheet of the corporate sector, financial sector, whether we look at the external account, whether we look at growth inflation dynamics, in absolute terms as well as relative to rest of the world. I mean, whichever way you look at it, I think the Indian macros are in a very, very good shape. We have political, social, macroeconomic, and financial stability, which has been hard earned, and over the next several years will keep us in good stead. So I don't have to talk much about it. The second is the corporate profit trajectory. We have seen the result season, but I think here, rather than looking at quarter on quarter, I think the more important is to look at overall trajectory of the corporate profits in India, and their corporate profit as percentage of GDP peaked at around 7% in 2007, and then I think bottomed below 2% post-COVID. Now it's back to 4.5%. What it means is that over the next several years, the point I made on macro, if India's GDP, let's say, grow at 7%, and you add another 4% or so of inflation at 11-12%, corporate profits have a potential to grow higher than that, because it's still at 4.5% or so. The peak was 7%, bottom was different, but I think if you are in a good cycle and some of the other things that have been done for the corporate sector, including the reduction in the corporate tax rate, and then during the COVID years and post that, leveraging on technology, everybody has become leaner and fitter. With that, if that, I mean, so corporate profits over the next several years can kind of like grow at least at the rate nominal GDP is growing, if not more. The third, on the liquidity and sentiment, while the four words are very dangerous in investing, this time is different. But this time in different in India is the retail flows, and particularly the SIP flows that we get. I think that is likely to continue and should increase more over a period of time. That kind of, apart from the EPFO and some of the pension fund money that comes in, NPS, if you add all of that, I mean, $40 billion or so constant supply of domestic money provides a lot of support to the market from a liquidity perspective. From a global investor's perspective, in fact, I feel positive over a period of time. They also returning, and we can discuss that a little later. But the valuation is where maybe some of this good that I talked about on macro, on profits, as well as on the liquidity side. The valuation, I mean, if those three are like dark green, valuation was looking like amber. But again, you have to be stock specific. At Nifty, since you talked about 22,000, I think I asked our fund managers what's the Nifty earnings expectations for the next year, and they said around 1100. So it becomes like 20 times or so. Is it like really too overvalued? Maybe relative to history, marginally overvalued, but not substantially, if you believe that our growth potential over the next several years is pretty decent. So from that perspective, macro, corporate profits, liquidity sentiments, they look good. Valuations are slightly higher, but valuations, I think, mid and small cap, there were some pockets where there was froth, but I think in last few days we have seen some bit of correction in that, and I think one needs to be more of a bottom-up stock picker now.
So as an investor, one should approach this market with full throttle, or he has to go to in a staggered approach?
I think that depends on your time horizon, on your risk appetite, on your return expectations. I think the liquidity preference and the other thing. I'm sure anybody in HDFC Securities who's serving the client will be in a better position because each individual is different. But if I take a 5-10 year view, I don't think trying to time it too much will really help you. I mean, we have seen how in last few days how the way market has treated, and every
Right.
time I mean, if you're trying to time it, you will get into influence of that short-term news flow. I think the best way to beat this volatility is to remain very disciplined and keep investing at all levels by, and an SIP is like a great vehicle. And now I'm seeing earlier people used to think that SIP is more like for those retail small investors who are doing small amounts. But now we are seeing, I think, some of the HNIs and ultra HNIs who have a large money to deploy in the market. I see them also finding that as a very good route to kind of put money to work.
I think this really gels with the Peter Lynch quote, which is said far more money is been lost preparing for correction or anticipating
Okay.
correction than having lost in the
You're
correction
so
actually.
right. I mean, you know what? I was discussing with someone that at the beginning of the year, Abhishek, if we had this call, and had I told you that this year in the election, we are not going to get a single party majority, and it's going to be a coalition government. And while the market had expectations of around 6 rate cut from US Fed, as of now, it looks like even, I mean, my guess is at best one, and that two post-US elections, and unlikely that they will have a window to cut in the July meeting or September meeting. September meeting will just be like 50 days ahead of the polling date in US. Had I
Right.
given you like those 2 or 3 data points, that I have a crystal ball and I can tell you, you would have thought the Nifty would be down like 10%, and maybe mid and small caps, which have done so well last year, they would be down like 15-20%, right? The fact is
True.
Nifty up YTD, and mid and small cap would be like close to double-digit return. So
You
that's
rightly
what my.
said, sir.
So trying to time it is like very, very tough. Even if you have a crystal ball and you know like what's coming, even then it would be tough. So uh, whatever. I mean, we don't have that crystal ball, so it's bad. Even if we have, we may make mistake. So without
Right.
that, I think it's better we don't try to time. Yeah.
So one segment of the market, which is FII, they have sold 35,000 crores as of till yesterday, and majority of this sale happened in May. How now, since again the election is behind us, how do they approach this market, and what kind of flow you are looking at from these FIIs? Is it passive funds or India focused funds? Some light on that.
So, from my interactions with the foreign portfolio investors for the last several months, they've been very positive on India. When they look at India relative to what's happening in other parts of the world, be it the developed markets or the other emerging markets, they feel very excited about India. The kind of structural reforms, the kind of the macroeconomic and financial stability that we talked about, the way we are kind of like preparing ourselves for a sustained growth over a long period of time, they feel very positive about India. Let me put it in a different manner. But we haven't really seen the kind of money that could have come to India, and why I believe it will come. If you look at last 32 years from the time the foreign portfolio investors have been putting money in India, almost 24 years out of them will be when they were net positive buyer of Indian equities. Why is that? Despite like many cycles, both global as well as domestic, the main reason were two. Number one is a structural macro story of India, a structural growth story from a like very low base of the per capita GDP, long way to go. So they like India as a macro story, and then of course rule of law, democracy, so on and so forth. The number two reason for them has been the bottom up stock picking opportunity. High quality companies across many sectors, be it financials, be it in technology, be it in healthcare, be it in industrials, be it in like utilities, telecom, across the board, they get many companies to kind of like choose from. Good management, very high quality disclosures, good corporate governance, good capital efficiency, so on and so forth. I think the third dimension that has got added, which makes me like very positive about foreign portfolio investors flows into India is the sustained flow of domestic money. Because of the sustained flow of domestic money, the FPI ownership has come down. They used to own close to, I think at the peak, 25% of Indian listed equities, and then that came down. I mean, the top 500 companies or so, and that has come down to now 16% or so, right? Because the domestic participation is increased. But because of this sustained money of like 30-40 billion dollars, and maybe another 2 years, this number may go to, let's say, 50 billion dollars or so. What this money is doing is reducing volatility of our market. Imagine, but for the domestic flows, where the market would have been today, right? I mean, while we think that there's too much of volatility, but even such a large event once in 5 years, and then results were not in line with market expectations, but like in 2 days time, we have kind of digested everything. That's the power of the domestic money. This ensures that India's volatility structurally would be lower because you have a constant flow of domestic liquidity. So third dimension of being positive on India has got added, which makes me believe that over the next several years, I think foreign portfolio investors would continue to look at India more and more positively. There will be some cycles, valuations are higher, they find some value in some other parts of the world for some time, but structurally, that's more tactical, but the structural money flow to India can only go up.
In fact, a lot of our investors may not be knowing that India's weight in MSCI has gone from 8 to 17 now, and
17.
at the same time, I think China has gone down from 40 to 25.
25 or so, yeah, 40 to 25 or so. Yes, absolutely right, yeah.
So,
the Chinese market, by the way, of late, last 3 months or so, China would have outperformed India, but that significantly underperformed over a long period of time. Last 10 years or so, China has underperformed India so much. So it's a small bit of catch up that may continue, but it's more of a tactical call than a structural call. I mean, a long-term structural allocation would prefer India over most of the other places within emerging markets.
Moving about markets and corporate, one thing, the latest print which we have on GDP, that was above 18%, which was primarily fueled by manufacturing, mining, and construction. Now, way forward, how do you look at FY25? Because one thing which we missed last time was consumption and private capex. So, what's your view on it, and how do you believe this will definitely go up? And keeping the backdrop that it will be a coalition government and things can have a different outlook, or probably the pace of things could be different.
So I have some views. Of course, it is going to be a coalition government, but remember one thing, I don't remember the final tally for the largest party is 240 or so, right?
Right.
It's substantially higher than what the largest party who was ruling the country between 1989 and 2014 is substantially higher than that, and many reform had happened during that period. Mr. Arun Jaitley used to say reforms is an art of possibility. I remain very faithful that I think structural reforms would continue. Even otherwise, I think a large number of reform that have happened over the last couple of years will keep us in good stead. What we really need is like the best execution going forward, and kind of ensuring that we leverage fully on what we have already achieved as an economy over the next several years. Even if, let's say, some of 2 or 3 legislative reforms that people were expecting, if there is another government with a full majority, even if they don't happen, I don't see that derailing or impacting the growth prospects, be it on the investment side, which is like you talked about manufacturing or private capex for the government infrastructure spending, or on the consumption side. And the other way to look at it is like agriculture, manufacturing, and exports. I see like a more broad-based growth going forward. When you look at the last year's data of 8%, the consumption, private final consumption expenditure, that grew at a much lower rate than the overall nominal GDP growth, and a part of it is due to maybe the lesser growth in the rural areas. Now with monsoon being good and maybe the percolating down or the trickle down effect of the spending on the infrastructure and a couple of other reasons. I think that also reviving going forward. And private capex is something that everybody has been expecting for some time. The government has done the heavy lifting. They were the ones who kickstarted the whole infrastructure spending and have done a phenomenal job. On a lighter as well as serious note, I've mentioned it a couple of times on these calls that one RRR, I mean, one Oscar went to RRR, the another should be to roads, railways, and renewables. I think in some of these sectors we have done a great job. Not to talk, I mean, even to not that some of the others like ports, airports, some of the other telecom, they've also done well, and I don't see that kind of like slowing down.
Okay. But so look, as we are talking about the government, there's some very obvious question comes up with this coalition government normally means more populist budget, which is more towards welfare and support of the society, or the upcoming budget will be as per the expectations of the corporate world and what actually India wanted to do.
So India needs higher growth. If you want to be a developed economy, we need to grow at a higher rate. But at the same time, we have to ensure that that higher growth rate is environmentally sustainable, it's socially equitable, and it's inclusive. And several times when there is some scheme which kind of benefits a large number of people, we just try to term it in like one word, populist, but we have to differentiate between one and the other. Over the last 10 years, if you ask me what is like some of the biggest reforms that have happened, people will talk about GST, they will talk about IBC, they will talk about RERA, they will talk about some of these things. To me, the biggest reform that has happened in the last 10 years is a high quality social security net. And I won't call that populist. I think a toilet for every home, a tap water for every home, a cooking gas, some of these basic things, let's say bank account, no frills bank account. On top of that, you give that Rupee thing, and then Ayushman Bharat and Sukanya Samriddhi, and now that the whole solar mission, and let's say a free food for it, I mean, or let's say for 800 million people. All of these are also good for the economy, right? What they do is like not only ensuring that people have quality of living, but also like that leverages the demographic dividend. So there is a difference between, now there's like this word called distributing revenues, something like very, very populist. But at the same time, I think if it is delivered well, something like, let's say the PM, that Awas Yojana, I think if it gives an opportunity for people to own their own homes, or let's say you provide better healthcare. Now Abha has got, that app has got, I'm told, almost 50 crore accounts. Over a period of time, this can significantly change our healthcare. I hope that this time we do a lot more on education, on healthcare, on skill development, and that shouldn't be taken as populist to me. I mean, 800-900 million people who are contributing very little to the growth prospects of India. Just think of it. If they come to the mainstream, what will be like growth opportunity for us? I mean, how much consumption can go up over a period of time if we really harness the power of the demographics?
Hey, that's true. But yeah, you are 100% right. So before we move on a little bit more inward and in terms of on the sectors, I just want to have your view on the global economy, especially with US elections coming up. What's your view out there? And I know the world is looking to India as India is shining, but definitely we are not isolated with the world. So your views.
So on the politics and the elections in other parts, I don't know whether it was J.K. Galbraith who said there are two kinds of people in the world, forecasters in the world, one who don't know, and the number two are, the second one are who don't know that they don't know. So I wouldn't really comment on the politics, but I just give you 2-3 data points. I think we spent so much of time on some of these things. I remember 8th November 2016, when people remember because of demonetization on that, but it was also the election of Donald Trump, which was a complete surprise to everyone in the market and a lot of people outside US. And markets fell because that the Trump got elected, and after that for next 14 months US markets were the best performing, one of the best performing markets in the world, and did very well. And similarly, I remember Brexit in June 16. I mean, every day if any poll shows that Brexit is more likely, that day sterling will fall, that day the US UK FTSE will kind of like go down, but post Brexit I think UK markets did well. Several of these things don't matter as much, but by and large, broadly the comment I would make is this time I think because of the structural factors, central bankers are finding it very tough to really support the economy the way they have supported since, particularly since the 2008 global financial crisis. Maybe a combination of reasons: the deglobalization, supply chain optimization also aids to inflation. The geopolitical risk has added to the inflationary risk in terms of supply chain disruptions. Climate change is inherently, I think, if you address that over the next few years, so greenflation is also there, and couple of other reasons. The amount of money that has got printed in last several years, both from the fiscal side and the monetary easing, has led to like higher inflation, and labor has just started getting repriced. Labor has got squeezed in large part of the developed world in last 30-40 years. It just started getting repriced. So because of that, inflation has been running higher than the expectations, and that's why rates are where they are. I'm in the camp of like higher for longer there. But the other way to look at it, more structural, comparing India, most of these countries have an aging population. While India's demographics is at its best, most of them have a much higher leverage as an overall leverage, as well as maybe public debt to GDP. I think India is one of those few countries, or maybe the only country, where the leverage is today as a percentage of GDP, debt as a percentage of GDP is lower than pre-2008. And most of these countries have lack of growth drivers and are dealing with anemic growth. I think will continue to remain one of the fastest growing economy for a very, very long time to come. So from that perspective, I think relative to rest of the world, India looks good. While markets are doing well in many other parts, just to extend that point, Abhishek, give me a minute. Yeah. US markets are up, but for a different reason. I mean, if you take out that magnificent seven, those tech companies and few others, rest of the market isn't doing well. Japan is doing extremely well. After several decades, market has crossed the previous peak, but it's mainly because of the corporate governance reforms and the reforms in Japan. But they have an aging population. It's not about a higher growth going forward. It's more about the same corporates, I think, getting governed very differently and focusing on minority shareholders. Some of the other markets are doing well, but for a different reason. I think India is where it's more about the broader macroeconomic story and a long-term structural growth, and a much more broad-based growth than any other part of the world.
Right. So I'd like to understand. So look, we all know the performance of most of the funds with HDFC AMC. Almost all the funds has been phenomenal, thanks to the capturing of themes like capex recovery and corporate bank. And in fact, obviously the defense theme, which was a NFO, which was a super hit, and then there was a pause in terms of subscription because of the fund getting more than one can chew sort of thing. So what are the key things now with post-election which you are focusing, and which you believe, A, the themes which will continue to shine, and B, the sector or themes which you believe will unfold over the next period of say 6 to 8 months or 1 or 2 years?
I think the broader story of domestic cyclicals, I think that continue, whether you play through, let's say, in manufacturing, or whether you play through the financials and then utilities and some of the others. I think that continues. We continue to believe that we are in an environment where India will continue to grow at a higher rate, driven by the revival of the investment cycle. We have seen, as I mentioned earlier, heavy lifting by the government, where they kick-started the overall infra cycle, but it will be followed by private capex. The other thing that we discussed some time back, that over the last few years, what we have seen not doing so well on the consumption side, but maybe and the so-called K-shaped recovery, urban versus rural, premium versus the mass market products, so on and so forth. I think at the margin, even the rural recovery, or let's say in the mass market consumption, I think that there are signs of hope going forward. I would say that I think the universe is going to expand even more. It's expanded in last 2 or 3 years compared to the kind of stocks that were doing well. It was a very, very narrow set of stocks that were kind of driving the market. In last 2 or 3 years, it's become more broad-based. I think it remains even more broad-based going forward. And in this market, I don't think it's so much about the top-down macro call or a top-down sector call, but a lot more would be about bottom-up stock picking. The another thing that happens is when this volatility has gone up in last few days, and if it continues, in those days, if you are a good stock picker, you get opportunities in a lot of places, right? I think some of the stocks or some of the companies our fund managers may not have looked at because they were, I would say, not so comfortable with the valuations. Now that some of those stocks have seen decent corrections, so that there could be some where the business prospects were good, they wanted to look at that, but it was the valuation that was inhibiting them from adding to positions. Even that may kind of like open up now.
So within the sectors, especially one theme which outshined last year was, or till this date, or till 3 days back, was PSU. What's your view currently now, way forward, how one should look at PSU, and if we split PSU into PSU banks and then other PSUs?
So there are parts of PSUs, like, I mean, and the Prime Minister himself quoted the profits that PSU banks have made, and their NPAs are at probably the all-time low, if not like maybe definitely at a decadal low, but I think probably all-time low. We have seen what the government has done for the defense sector. We have seen, I mean, some of the other, and then most of them are kind of like play on the domestic cyclical growth, and also the governance reform that has happened. The way, I mean, a lot of credit to the DPAM in the finance ministry and to the government in terms of ensuring that how to ensure that they create more value for the minority shareholders. I think the way earlier FPOs or the ETF the way they used to dilute, I think it's a lot different. There's a lot of focus on profitability, a lot of focus on creating value for all shareholders, and I think it has re-rated the entire PSU basket. Some of them, I think, completely continues. And there is a small part of the public sector where the narrative has taken over, and where the valuations have run substantially ahead of the fundamentals. That's why you need to differentiate, but there are still some of the companies where I think the structural growth story, both because of the businesses they are in and also the structural improvement that has been made to make them focus a lot more on profitable growth and return on capital ratios, I think they will continue to do well. But one needs to keep in mind, as I mentioned, the valuation aspect also. One should not have like just a basket approach.
Right. One sector which is more of an external, external looking, which is primarily our IT and pharma. We have seen mixed kind of a response. Obviously, this sector was some time back. I think post-COVID, this was the darling for at least 1 year, and then suddenly there was the gear shifted to a different side. Your views on that?
I think healthcare has done quite well. In fact, even in our manufacturing fund that you talked about, I think has got decent allocation to healthcare. So is the case with some of our other funds. IT is a bit tricky. I mean, on one side, what's happening in the entire AI space, how this will impact Indian IT is still open for, I would say, a debate. Whether, I mean, AI is very transformational, I know that, but we have seen several big shifts before, and Indian IT was a big beneficiary, right from the Y2K, where people thought probably this is the last thing they will do, but they have been constantly evolving themselves, both sides, I mean, in terms of productivity as well as finding newer ways to growth. So whether it was the migration to cloud from server, or whether, the whole, I mean, from the infrastructure maintenance to more of the cloud, or whether the whole digitization, they took advantage of every single I would say transition that might have happened in the technology world. And as more and more businesses, as more and more organizations spend more money on tech, Indian IT was like very well placed to take advantage of that. Now AI is like a very transformational force. How this will impact in terms of the core work that we do, whether it helps them in getting a non-linear growth where they don't need as many coders and people, and can kind of like transform their business model. Or I really don't know. That something is still open for debate, whether this will be another big leg up for their growth prospects, or it can impact the business model itself. And who are ready for that? Yeah. In India, that in a good position. I think if you look at India as a kind of like from an AI perspective, I think we have large number of people. We have lots of data. We are the most data rich country in the world. We were the most data poor maybe till 10 years back, but the amount of digital footprint all of us are living every day in every sphere of our life is just phenomenal. What an amazing laboratory that we have got for that. And then we have the talent who can like really make sense of this. So this could be a big opportunity, but in what kind of businesses and who can leverage that fully is still open. Yeah.
Got it. Similarly, your this power sector, metal, and so these two normally are closely correlated.
I'm not like a fund manager. I mean, I'm telling you all of this based on what I hear from our fund manager.
I think I'm getting a lot of questions on
But
YouTube and or
power,
to
there's one thing when you were
yeah.
asking me about even global. I mean, of course, I mean we have seen the heat wave and even otherwise, the power demand has been surprising on upside, and I think maybe I think after now that elections are over, you might see some power cuts because everybody would have ensured good power during this period, because there is generally like demand has been increasing pretty well. In fact, globally, I'm sure you would have heard about it that given the way data centers, given the way the entire the AI move is, one of the thing that needs to keep in mind is it is going to guzzle a lot of power, and one needs to innovate a lot more for that.
So moving little away from the equity market, look, we all are waiting for the interest rate cuts because obviously it is linked with US, and then US is holding on to the year started with 2 cuts and 3 cuts, and then eventually we are ending up with probably it may end up with no cuts at the US. But how is the interest rate scenario looking in India and the liquidity situation right here?
I think so. RBI has been maintaining a hawkish tone simply because I think inflation has been running above 4%, their comfort level, while over the last couple of months, the print has been coming good. The core inflation has also been looking good, but I think they would like to see a more decisive move downwards on a sustained basis to ensure that inflationary expectations are well anchored. The global environment is such where maybe the US Fed, as I mentioned earlier, last year in the month of March, when 3 banks failed in US, people were expecting many rate cuts and a hard landing. And then it was like kind of like soft landing and few rate cuts. But again, I think there was like no lending. Right. Again, at the beginning of this year, 6 rate cuts were also were expected, but now we are already in the month of June, and my sense is that by July they won't have a data point to justify a cut, and then in the next meeting, September, they would be very close to polling, and Fed would like to retain its kind of reputation as apolitical. Then it'll become tough. So then the only window left is post-election. That's in the month of December. By that time, economy, I mean, the growth moderates a bit, and they can justify if inflation is below, let's say, on a monthly basis, core PCE or something below 0.2 or so. So from that perspective, it's not very easy for RBI to start getting now. And of course, when the economy is growing at 8%, whether all your other high frequency data are pointing towards a good growth momentum, the justification for a rate cut would also be, I think, if inflation is substantially below the target level. So I think it's still a few months away. On the liquidity side, with RBI giving that large dividend check to the government, and now government has accumulated a good amount of cash balance, which has also tightened the liquidity. Now with the new government coming back when they spend the money, I think overall liquidity situation in the system will improve. Our advice from our fund managers over the last several months, actually several quarters, have been that when the 10-year was like somewhere between 7 quarters, 7.5, they've consistently been saying that there's a time to lock in for long term, and our income fund and the long-term income fund has been like growing decently. We continue to believe, I think at these rates, investors should take exposure to long-term bonds.
Right, right. So now moving away from interest rate, last 2 questions before I know we are moving ahead of time. On gold, your views, because that remains a very primary asset, but people hold. And whenever we do a call, there's always a question on gold.
No, I think Indians have a fascination even otherwise, but now that globally last 2 years central banks have been big buyers of gold, it's kind of like diversifying from let's say some of the other currencies, but still while their buying is so large relative to let's say the whole demand supply dynamics of the gold, but as a percentage of their reserves is still very, very tiny, very small. So I think if they do a little more, it can have significant impact on prices. The whole I think the weaponization of dollar that US did post the Russia-Ukraine war, and the way the public debt to GDP is in US and some of the other developed countries, it's a hedge against like anything that goes wrong with fiat currencies. It's a hedge against the geopolitical risk, which has kind of like really gone up in last couple of years. I think we are seeing hot wars among some of the nuclear powers, and then there is a big Cold War going on between West, or probably I would say the whole world, and China. With all of that, gold has been like a good hedge, has been a good diversifying force. But I always say that because gold doesn't earn anything, it should just be like a small part of a portfolio, and it should be taken as like buying an insurance policy when you buy a car, right? You don't want your car to get hit. You don't want all the risks that are highlighted to really materialize, because in that case, rest of your portfolio won't do well or will take a significant hit. But just in case that happens, you have a hedge. So gold should be looked at from that perspective.
Yeah, definitely. In fact, some relief to all the customers who are buying sovereign gold bond. At least you get 2.5% interest rate flowing to you, rather than the pure gold or physical gold in comparison.
Gold ETF, I think one can buy and sell through gold ETFs.
Right, definitely, because gold ETFs are available throughout. Sovereign gold bonds are limited during the series when they are on.
SIP through a gold fund, or invest in multi-asset where minimum 10% allocation goes to gold. Yeah.
So thanks for giving you time. I think there are a lot of questions on stocks. So all the investors, just to tell you, we can't ask stock specific questions though we try to address them. But I'll request you can park those questions to our session from equity markets from HDFC Securities research, and our research team will definitely answer those questions. Or you can post your questions to your relationship managers, and they will definitely go back to research and come back to you with your answers. For all the people, because I've got 2-3 queries in terms of where we can get to know about this webinar, because some people have joined late. So this webinar will be available on HDFC Securities YouTube page, and you have to write sir's name and you will find it. So it's so easy. And so this is the latest webinar which we have done. The link we have already shared to all the investors. For any client who wants to understand what we are recommending from HDFC AMC, we have a list of funds which are on the recommendation basket that is available through all our portal, which is HDFC Sky, Invest Right, which is the app and or web platform, and also on Invest Now. So I'll request each investor to go and understand these funds. These funds have given good amount of returns. Trajectory also look positive. We cannot give you a number, but definitely as the corporate profitability moves next to the nominal GDP around 12-13%, we are pretty sure that these funds will try to add little more alpha to it and give you the performance over long run. And So that's it. And thanks, Mr. Navneet, for giving us the time. We really appreciate you and you coming down and addressing so many questions. They are still coming up. So, but we need to pause it now. And thanks for your time, and thanks all the clients who have joined this call.
Thank you.
Pleasure.
Thank you.
Thank you. We may close the call.